I am Dr.S.Chandra, Assistant Professor, PG and Research Department of Commerce, Sri Sarada College for Women, Salem. Today we are going to discuss issue of shares. First we discuss what is share. The capital of a company is divided into shares. Each share forms a unit of ownership of a company and is offered for sale so as to raise capital for the company. What are the types of shares? Shares can be broadly divided into two categories: equity shares and preference shares. Equity shares give their holders the power to share the earnings or profits in the company as well as a voting rights in the annual general meetings of the company. Such a shareholder has to share the profits and also bear the losses incurred by the company. So preference shares means the holder of the preference shares only they earn dividends which are also fixed and giving no voting rights. Then we discuss what are the types of equity shares or what are the classification of equity shares. We have classified the equity shares under three categories. The first one is classification of equity shares based on share capital. Under these classifications, we have classified the share capital into four categories. The first one is authorized share capital. Every company in its memorandum of associations requires to prescribe the maximum amount of capital that can be raised by issuing equity shares. The limit, however, can be increased by paying additional fees and after the completion of certain legal procedures. The second one is issued share capital. This implies the specific portion of the company's capital which has been offered to investors through the issuance of equity shares. The next one is subscribed share capital. The portion of the issued capital which has been subscribed by the investors is known as subscribed share capital. Paid up capital. The amount of money paid by investors for holding the company's stocks is known as paid up capital. As investors pay the entire amount at once, subscribed and paid up capital refer to the same. The next classification is based on definition. Under it, we have four types of shares. The first one is bonus shares. Bonus share definition implies those additional stocks which are issued to existing shareholders free of cost or as a bonus. The second one is right shares. Right shares mean is that a company can provide new shares to its existing shareholders at a particular price and within a specific period before being offered for trading in stock markets. The third one is sweat equity shares. If as an employee of the company you have made a significant contribution, the company can reward you by issuing sweat equity shares. The last one is voting and non-voting shares. Although the majority of the shares carry voting rights, the company can make an exception and issue differential or zero voting rights to shareholders. Then we classified the equity shares based on returns. Based on returns, we have three types of shares. The first one is dividend shares. A company can choose to pay dividends in the form of issuing new shares on a pro rata basis. The next one is growth shares. These type of shares are associated with companies that have extraordinary growth rates. While such companies might not provide dividends, the value of their stocks increases rapidly, thereby providing capital gains to investors. The last one is value shares. These type of shares are traded in stock markets at prices lower than their intrinsic value. Investors can expect the prices to appreciate over some time thus providing them with a better share price. The second type of share is called as preference shares. Preferential shareholders receive preference in receiving profits of a company as compared to ordinary shareholders. Also, in the event of liquidation of a particular company, the preferential shareholders are paid off before ordinary shareholders. Then we discuss types of preference shares. Totally we have 8 types of preference shares. The first one is cumulative preference shares. In the case of cumulative preference shares, if a particular company doesn't declare an annual dividend, the benefit is carried forward to the next year. Non-cumulative preference shares. Here the benefit doesn't carry to the next year. The shareholders receive their dividends in a current year itself. The next one is participating preference shares. Participating preference shares allow shareholders to receive surplus profits after payment of dividends by the company. This is over and above the receipts of dividends. Non-participating preference shares. Here the shareholders carry no such benefits apart from the regular receipt of dividends. Then convertible preference shares. Convertible preference shares can be converted into equity shares after meeting the requisite stipulations by the company's articles of association. Non-convertible preference shares. Here the shareholders do not have any option to convert their preference shares into equity shares. Redeemable preference shares. A company can repurchase or claim redeemable preference share at a fixed price and time. These type of preference shares are sans any maturity date. Irredeemable preference shares. On this type of preference shares, we are not get back the amount during lifetime of the company. We get back the amount only at the time of winding up of the company. Then we discuss steps for issuing the